On Friday, Silicon Valley Bank, a California tech startup lender, collapsed pretty dramatically. So now the FDIC, according to news reports, officially took control of SVB on Friday after California regulators had shut it down when it failed it basically ran out of money. That's what happened. It ran out of money. Its stock crashed. Everything completely fell apart. A collapse is a collapse is a collapse. And that's what happened. All right. So now, on Sunday, the Treasury and the Federal Reserve announced that they had stepped in to guarantee uninsured deposits and offered loans to other banks so that they would not have to take losses as a result of the mismanagement over at SVB. So now, the Wall Street Journal is like, oh, well, it's kind of a de facto bailout. But here's the thing. Depositors, well, they should get their money back because depositors weren't the ones making the risky bets. So this is actually why this is sort of different, or actually really different from the bank bailouts back in 2008. So these are, again, depositors, a lot of them businesses that put their money in the bank, and the bank basically did risky bets with it. So I'll explain what that is, all right, and what had actually led to this entire thing, okay? But as the Wall Street Journal noted, about 85 to 90% of SVB's deposits were uninsured by the FDIC, which only insures up to about $250,000. So you might think, oh, that's a lot of money. Well, to me it is. But generally, if you're a large or even medium-sized business, you would likely have more than that. So I guess that's why the Biden administration said, don't worry, we're going to make all the depositors whole. And I actually, again, don't really have an issue with, making sure to have the depositors being able to get their money. The issue I have is investors or executives, people like that, getting access to that money. But anyway, so now, the government said that they would guarantee deposits at SVB and also at Signature Bank in New York, which also failed over the weekend. So now we have two bank failures. Right. Now, as the Washington Post reports, the decision by the Treasury to backstop all deposits at SVB and Signature, not just those up to $250,000 that are insured under federal law, rested on a judgment that it was necessary to avoid a wider systemic meltdown. And so I get it. You're trying to avoid a run on the banks, which could, again, be even more disastrous. So as I said before, if you're going to, do this for depositors, okay, that's fine. Again, this is no fault of their own. They put money in a bank. The bank screwed it up. Fine. Bail out the investors? No, not fine. And so far, I haven't seen any plan to do that. Okay, so now, a statement on Sunday by the Federal Reserve, Treasury, and the FDIC also noted that no losses associated with their rescue plan would be borne by the taxpayer. They're saying that basically all the banks are going to be responsible through assessments, and that the SVB's assets would be sold off. That said, before the statement, there was honestly a lot of concern that this was going to be a bailout of investors by the taxpayer, the same as, of course, the bank bailouts back in 2008. Now, Senator Bernie Sanders, who was against that, had also come out against that idea as well. And he's right. Here's what he said in a statement. If there is a bailout of Silicon Valley Bank, it must be 100% financed by Wall Street and large financial institutions. We cannot continue down the road of more socialism for the rich and rugged individualism for everyone else. Yes! 100%. Agreed. Now, he also added, let us have the courage to stand up to Wall Street, repeal the disastrous 2018 bank deregulation law, break up too big to fail banks, and address the needs of working families, not the risky bets of vulture capitalists. Sanders then, of course, went into detail a little bit about the deregulation that led us here, saying, let's be clear, the failure of Silicon Valley Bank is a direct result of an absurd 2018 bank deregulation bill signed by Donald Trump that I strongly opposed. By the way, this is not just Republicans. This was also bipartisan. We'll get into the details on that. But his statement continued by saying, 5 years ago, the Republican director of the CBO released a report finding that this legislation would increase the likelihood that a large financial firm with assets between $100 billion and $250 billion would fail. Let me get to the irony of that. He said, that is precisely what happened. Now, look, 2018, understand, if you missed this, I get it. The insanity of the Trump administration. Yeah, we missed the fact that, Republicans were also pushing a deregulation agenda. In fact, 17 Democrats joined with 50 Republican senators and voted to sign a bill that would remove the requirements for banks with more than $50 billion in assets to be subject to liquidity requirements and more frequent economic stress tests. Oh, look at that. 67 senators. And you have Bennett, Carper, Tom Carper, Chris Coons, again, all these Republicans, Donnelly, Heidi Heitkamp, Maggie Hassan. Just you go down the list. Tim Kaine, Joe Manchin, of course, Claire McCaskill. Gary Peters. Yeah, I'm picking out all the Democrats because we really expect all the Republicans, and they did, all the Republicans. Oh, yeah, bank deregulation. Oh, yeah. But then, of course, you have the corporate Democrats. Again, this is the pro-banker, pro-corporate wing of the Democratic Party that signed on to the Trump deregulation bill that led to the collapse of SVB. We should not be surprised here. So again, Donald Trump signs that bill into law, brags about, I got rid of the deregulation, I got rid of the regulation, I deregulated the banks, I made it so the banks would be better, bigly, the greatest banks. Okay, well, now that said, back when this was being debated on the floor, there were some Democrats that stood out against this. In fact, I'm going to show you a certain senator here who spoke out very vociferously against this.
And against my strong opposition, then, Congress and the Federal Reserve provided the largest taxpayer bailout in the history of the world to these huge banks because they were too big to fail. But now, 10 years later, hoping that we forget all about that, these large financial institutions are back again. How pathetic is that? Just yesterday, the Congressional Budget Office told us that the legislation we are debating today will, and I quote, increase the likelihood that a large financial firm with assets of between $100 billion and $250 billion would fail, end of quote.
No, and would you look at that? That's exactly what happened. Bernie Sanders saying back in 2018, hey, maybe we shouldn't deregulate the banks. Now, SVB, as I pointed out, they were a medium-sized bank and had $209 billion in assets. Man, it's almost as if Bernie Sanders, right again. Isn't that weird how that works? He comes out and he says, well, I think this is probably a bad thing to go ahead with this deregulation. What if this bad thing happens? And then a few years later, bad thing happens. He's like, I told you. While everyone in the cabinet said, how could this have happened? How could this have happened? Never could have seen it coming. So again, let's get to the details, right? So they were deregulated, which allowed the bank to use depositor money for investment. So now there used to be a law that separated investment and commercial banks. It was called Glass-Steagall. It was removed, unfortunately, and so we had the basically commingling of these different types of banking systems, and what you ended up having is depositor money being used to make risky investments far more than the liquidity that they have on hand in case that those bets lose. And that's what happens, and that's why banks fail. Yes. So now in this case, there's a lot of mismanagement at SVB and a lot of bad decisions that were made. So now, interestingly enough, the investments that SVB had made were actually in safe treasury bonds. So these are government 10-year treasury bonds, which are generally considered to be very, very safe. So you may think, wait a minute, how is that a problem? I mean, if these are safe investments, well, again, for one, they made these investments with most of the depositor money. They did not have enough cash on hand for what had come next. Now, had they been properly regulated, then they would have been forced to have enough cash on hand so that they were not shuttered, that were not left in massive amounts of debt. So now, the reason that these government bonds ended up not being safe was thanks to the Federal Reserve. Federal Reserve, which then, of course, they raised interest rates. I've talked about this a little bit before. The Federal Reserve, in order to combat the inflation, had to go and raise the interest rates, which, of course, made borrowing more expensive, but also had the result of taking the bonds that were previously issued, which were at a much, much lower interest rate, so therefore weren't paying out. They had to sell these bonds at a massive loss. And so they just didn't have enough money when the depositors came to get some of their money out. So now depositors, of course, were also reeling from the higher interest rates. Since again, it was more expensive to borrow money. And of course, when you are a business and you get loans, when you pay back the loans, you get a higher interest rate, then you got to pay more on that loan. You get how that can impact businesses. And of course, there are businesses that have to make payroll, so they take some more of their money out of the bank. But these depositors took too much money out of the bank because the bank didn't have the money to lend them, or to give them their money back, I should say, because they had invested too much of that depositor money into those bonds that were giving the executives a return on investment and investors. And so this was done, of course, to maximize profit, in which, of course, shareholders received and employees received bonuses from. So yes, that's essentially what happened. Now, the other interesting thing about the rate hikes is that they said that they were doing so, the Federal Reserve, we need to cool inflation. Is inflation all that down at all? No, the result of inflation, again, is yes, increased borrowing costs and increased costs on businesses, as we've seen. And of course, decreased yields from treasuries, the 10-year treasury bonds. But it also was there to cool the economy by increasing unemployment. Okay. Now, the whole point of increasing unemployment is to decrease wages, to drive wages down. That was the overall goal here, I believe, from the Federal Reserve. Because again, most of the inflation that we have seen is not just a result of, again, higher prices due to COVID, because that's where originally it come from. Yes, some price increases, sure, are from increased supply costs, supply chain issues caused by COVID. But most of it's corporate greed. That's where it came from, corporate greed. And so, of course, raising interest rates was not going to solve that issue. But it did create a whole lot of other unintended issues, coupled with the bank deregulation, which led to the collapse of both SVB and Signature Bank. Which again, also, before the government decided to step in, people who had stores on Etsy, for example, were facing the possibility that they were not going to be able to get their money. Again, there's a lot of businesses, small businesses, independent people who are on places like Etsy, A lot of smaller businesses, again, were depositors in SVB that would have just completely and totally effed. So, yeah. It's just an absolute disaster. Now, here's the kicker, though, right? I talk about regulation and deregulation. Unsurprisingly, SVB's chief executive, Greg Becker, was a big supporter of Trump's rollback of these regulations. He had served on the San Francisco Fed's board of directors and had sold $3.6 million of Silicon Valley stock under a trading plan less than 2 weeks before they disclosed their extensive losses. And on Friday, actually paid out annual bonuses to employees. So now, wait, if your bank is going under, why are you paying the bonuses? Like, I know, I get, but this is from work done in 2022. Yeah, still, I don't know, that seems to be a problem, okay? Look, SVB employees, by the way, are paid an average of $250,000 a year, which made the bank the highest paying publicly traded bank the previous year, which is, again, that was according to a 2019 Bloomberg report. And per Glassdoor's latest update on March 9th, the highest paid role at SVB was managing director with a salary of $583,566. So they were pretty well paid. Speaking of well paid, again, according to CNBC, top executives, including the CEO, stole their shares worth $4.5 million before it collapsed. So I'm sure that's a coincidence, though. I'm sure. Look, here's the thing. This is an obvious example of deregulation and what happens. And it seems to be a theme. You see, we've had deregulation in so many industries over the last, few decades. And this is coming right off the heels of the rail industry being so deregulated that we have seen a massive increase in derailments in places like East Palestine, Ohio. And again, many other places, many other derailments that have happened since. Deregulation. That is the problem. Deregulation destroys. And again, in every single example here, lobbyists from these industries said, you got to eliminate the onerous regulations. You have to get rid of the regulations. We're drowning in government bureaucracy and red tape. No, it turns out you need rules. And the reason they say that is, of course, they're not actually drowning in bureaucracy and red tape. They just want to make more short-term profits. And that's really it at the end of the day. And yes, some of these rules make it so that you don't cut corners or make risky investments if you're a bank, or, by the way, don't have to upgrade your Civil War era braking system if you're a rail company. Now, that's going to cost you money in the short term, and that sucks. But in the long term, it's actually going to help your business, because when there's an emergency, and there always is, Murphy's Law always does apply. If something can go wrong, it will. And it seems to always happen after deregulation. They remove these rules, and guess what? Something bad just happens to, happen. And there you go. You have a disaster. So, again, when people like Bernie Sanders and progressives come out and say, hey, maybe we shouldn't remove these regulations, maybe we should have stronger regulations, we should have rules, we should re-implement things like Glass-Steagall, to actually protect the economy overall, at the expense of, yes, a little bit of profit, we're right. Because if you don't, we're living in the time, in the era where we don't have these regulations, and would you know it, bad things keep happening.